Hey guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we're going to be talking about some chemical companies that Fabio has been doing some research into. So without further ado, we're just jumping right into this. What are we looking at here today?
So the first two, I guess, should we just say right off the bat what the two companies are?
Oh yeah,
I guess so.
Yeah.
So the two companies are Dow Chemical and Lyondell Industries. Okay, so
Leon Bessel,
Liam Bessel,
yeah,
Liam Battle, Liam Bobble.
yeah.
Anyways,
LYB,
LYB.
Easy.
So ticker symbol DOW for Dow and then LYB for the other one. So the differences between these two primarily stems in the where they're from. So LYB, that's we'll call it that from here on out to make it simple.
Mm-hmm.
LYB is from the United Kingdom and then Dow is from the United States. And these are the two largest chemical companies in the entire world that are strictly chemical. Okay. So you would see their products used in a bunch of different industries. And I think we were looking at, for example, LYB, a lot of their chemicals are used in like Legos, right?
Well, they
Make Legos.
they build the compounds that go into ABS plastics that are then what Legos use. But what I find interesting, at least like my preliminary thought of LYB, is that what I noticed was I was noticing a company that was like pretty much manufacturing the DNA that multiple other companies and multiple other industries would take advantage of and then use to build their products or et cetera, so forth, just literally conduct their general business day to day. So those were my like preliminary thoughts kind of coming into this and just sort of taking a look at some of these chemical companies. But now I'm kind of wondering if what is a thing that distinguishes Dow from LYB, or are they kind of similar? It's just one is placed in Europe, the other's placed in the United States.
They're both very large conglomerates in the chemical industry. I'd have to be a chemical engineer to know the specifics as to what are the intricate differences between the two. And maybe someone out there is a chemical engineer, and you can actually comment down below if you know of any major differences such as that. But we'll be sticking to the operational side. And I'll kind of give a first thought that British companies right now, as we speak, are actually trading at discounts relative to American counterparts. And I actually expressed this in the the BTI and Altria video, because those two companies are very similar. However, one is based in England, the other one based in the United States. The American variant is actually trading at a premium relative to its British variant. And this is because there's been a capital flight to the United States.
Okay.
Mm-hmm.
I was about to ask that because there's been a capital flight to the United States. Would you I can sort of piece together what a capital flight might be, but would you kind of define that for our audience, and then also sort of talk a little bit now about how this could be both a good and bad thing for investors moving forward?
Yeah. So basically, to keep things simple, the rest of the world kind of sucks economically. I'm oversimplifying it, but and then investors around the world don't want to invest in their markets, and they would rather invest in the American markets for whatever reason that may be. And then so that has led to a measurable premium in the American versions of these companies. So if you have, two equivalent companies and one's based in the United States, the other one's based not in the United States, the American one will have a premium right now. That may change. That may change at any point. However, we're just talking about the current reality. And we'll see that in the model when we get to look at the numbers. It's pretty apparent that LYB is trading at a discount to Dow, despite having equal or even in some instances better metrics.
Okay, so to kind of orient my thinking and to help out the audience as well, going into this, we're going to be seeing two companies that for all extent and purposes, all intents and purposes, it's basically the same company. One's placed in Europe, the other's placed in the US. However, what we're going to be seeing reflected in the numbers, the story that the numbers is telling us is that we're going to be, the European company will be trading at a discount from the US company.
Correct.
So now my question kind of comes down to, what is it about chemical companies that really actually make them operational? Do they have patents on different chemical compounds? Can you even patent a chemical compound?
Yeah.
Am I making sense with the questions that I'm asking?
Yes, and yes, and yes. And then on top of that, I mean, one of the attractiveness about the business is actually that it's boring. I mean, I assume that our audience a lot of them may find this to be a very boring company to talk about.
I love boring
But
businesses personally, but that's
yeah,
just me.
that's sometimes why they're overlooked. So boring is sometimes good. And if you hold a boring company long enough that performs, that executes, then you're going to do very well for yourself over time as it compounds for you. So the world itself, humanity needs these compounds. We know that. And for the foreseeable future, that's what we will use. If, in fact, I expect it to increase, not decrease, the use of these compounds. And this is inherently a dirty business. It's a business not many want to get into. So it's something that Amazon, for example, won't really want to get into. It's not attractive. Again, it's boring. It's not exciting, but it's necessary. It's kind of in the background, something you're not really paying attention to,
But it still
but it's all
is
around
there.
you. Exactly. So you look around yourself and you see all the products that surround you. And a lot of these are actually made with chemical compounds. And the home you're in, a lot of the home is used with or made with chemical compounds. So that's something we want to
yeah, and that sort of leads me to my next question here for you now, where I was legitimately going to ask, what are these compounds used for? Because when I was looking at LYB's website, I saw they had ethanol, they had all of these different
I'll leave that out.
plastics.
Yeah, you see,
yeah, they had like a lot of different things. It's just okay. So yeah,
I'll leave that out because we'd be here forever. But
yeah,
in broad terms, these two are one of the largest in the entire world, if not the two largest in the world. And they're pretty much in a lot of things. Okay. So we're not going to be focusing, because if it was a smaller company, I'd spend more time on that. But if we were to really spend time on that, it's too many. Okay. It's too much. They're in too much. So let's actually just take a look at the, I guess the price action, the price movement.
I'm also curious too about who the customers of these two businesses are. If this is a business to business type business, or if it's a business to customer, it's a business to business.
Yeah, because you need them for your products and stuff like that. So, so from here we can see the performance has been pretty choppy. It had its initial run up to about $114, and it's actually lower than it is then. So this is, we can probably tell it's in the era of exuberance. So this is when the business wasn't boring and everyone wanted in on this. And then it kind of stagnated and hasn't really done anything. And actually you've been down 21% since you invested in here. So what this tells me is you have to be careful at your end of what entry point you have, and you have to be opportunistic when you add. Now they do pay a handsome dividend, but that dividend isn't supposed to be our focal point. Our focal point at the end of the day is to drive capital returns that are meaningful in our portfolio, and then have each position be very strict as to what you let into your portfolio. And then each position has to have a purpose, has to have a meaning to why you're adding it. Be very strict with what you let in. This is why Warren Buffett talked about the punch card theory of investing. Imagine you have a punch card with 20 options, right? And you only have 20, all right? So are you going to be more careful if you only have 20 options in your entire life? You will. So he's saying you don't have 20, you have more than that, but invest as if you did. And in that case, you're going to make less investments, right? But you're going to be very careful as to what you let in. So just because the price is down now, that doesn't mean it's good. Just because the price is up doesn't mean it's bad. So, right here, we had a crazy opportunity, in my personal opinion, when we look at the numbers. This was an entirely de-risked position. And if you didn't think the world was going to end, then that was the best moment. That was a beautiful moment. So hindsight's 2020, and pun intended as well, by the way. But at any point you could have, right here at this point, you could have said, oh, the world's definitely not ending. So could have added. And then even here, the world's definitely not ending. So we have to judge it on the now and then say, okay, under the current price, what's priced in, what's not priced in, is the world being too pessimistic on this business, etc. So, and then if we look at Dow actually,
before we move to Dow, I just have a question here, because you indicated earlier that you want to be careful about the entry, about when you decide to enter into this stock. And I'm wondering now, what could be at least just some thoughts in your mind about when, if you were to make this investment, you would want to enter this? Like, what are some things you would want to see regarding that?
Okay, so what I want to see is where it's priced to the point where a subpar performance in the business, in other words, a slow growth, I don't have to assume too much, because that's what I expect from this, because this is more of a mature industry. I do expect us to use more and more chemicals in the future, but we're in a mature industry. So I want to expect low growth, right? And still come out on top. So that means the price I pay really matters. I have to pay a low price.
Okay, so the price, okay.
Yeah, I have to pay a low price for a good asset. It's a stable asset, right? I know that. I can already tell because of the business it's in. It's going to be a stable asset, and it's not going to have hefty fluctuations. I mean, you can see here since 2014, it's been up and down, but staying within a range, right?
Mm-hmm.
So basically, if I can presume from the market, kind of getting ahead of myself here, I can presume that these bottoms right here, if I could get it in the 80s, that seems to be like a resistance point, a strong resistance point. You see, I don't have the proper tool in front of me, but we can draw like a trend.
What does resistance point mean in this instance?
So resistance point is simply where the market kind of there's a lot of buyers coming in there, and then the sellers kind of subside, and then the sellers seem to be coming in when the stock's around the 114, 120. So at that point, if the fundamentals aren't changing drastically, you want to pay attention to that, because if the fundamentals are changing drastically to the favor, then you could make a justification for new highs, right? Instead of staying the same. It wouldn't make too much sense. And if this business is buying back shares, which we'll actually see, then eventually this is to the benefit of the shareholder if the price remains undervalued. That's where buybacks are good. So I've expressed my concerns about buybacks and just blanketly saying all buybacks are always good, way better than dividends. It's like, not necessarily. With buybacks, we are presuming that the business is doing at opportune levels, right? Presuming that the management is doing it or executing it well. If not, they're destroying shareholder value.
And then just to kind of touch on that before we move on to DOW, what constitutes an opportune time? Would that be you would want them to buy back when the share price is lower in this instance?
When the share price is cheap enough where the value or the destruction of those shares is value accretive. Okay. So it depends on the industry. So for example, insurance industry, you would want it to be when it's below book value. When it's below book value, you're actually, in some ways, you're printing money. And then if you're in a software industry, so if you see that if you do a model, you do a financial analysis of the business and you think the value or the discounted cash flows or the discounted future cash flows, and you discount them to today and the present value is higher than what the stock price is trading at, then you'd say, okay, management, I think now is a good time to buy back those shares. Because if you buy back the shares now, it will actually further the value of the remaining shares. And you're buying those shares when the present value is lower than the projections, right? And then you have to trust in those projections. Then it comes a matter of execution. But you don't want to be in a situation like IBM, for example, that did shareholder destruction, buying shares when they was expensive, when the company was expensive. And now that the company is cheap, they can't buy as many shares up because they destroyed the balance sheet. And they were buying up shares to make up for their inadequate execution. And that is terrible. That's value destruction. Now, you have some instances of like Google, where Google, again, you could made arguments when they started their buyback programs that the PV was higher than their share price, and they were buying up shares, right? And then it ended up being good. And that's the key. The present value has to be higher than the current value of shares. And okay, so there has to be not much for them to be able to do with that capital. Okay. That's another thing.
So hold on. That last part confuses me a little bit. So you want the present value to be more than the price, but then would you just kind of elaborate further on the last part of that you said?
With Google?
Yes. Which was,
Yeah. So Google is making so much cash left and right. And the PV, I can tell you because I own Google in my portfolio. And when they started announcing the buybacks, the present value of the future cash flows of Google by even my most modest projections were higher than the current share price. And that's why I was adding it. And the management team probably saw that. They're not stupid. And then they were saying, okay, well, we're going to start buying back shares. And they were diluting shareholders for a long time because remember, the value of these future cash flows is contingent on the eventual potential of capital returns. And finally, they're doing capital returns. So they decided to do capital returns once they figured out we're making so much money that we don't really know what to do with it. And then they see, okay, what is our growth rates going to be? What is our projections going to be? Well, we think that they modeled it out probably. And they said the present value is higher than the current valuation of the company. So we'll buy back shares. And it ended up being a good move. In hindsight, it was a great move. Same with Apple.
Okay. So now kind of moving back to the chemical companies, this is a video about chemical companies.
Yes.
What is, do you have any nuggets of knowledge maybe about materials? I could probably say that this exists in materials about when management should or should not be buying back shares as it regards to the materials sector or materials industry.
So it depends on the cyclical nature of the industry. So that's where you hope management understands the business they're in. I hope they do, because they're the CEO of that business and the CFO of that business. So they hope they definitely should. Now, that being said, sometimes they still mess up, because again, I pointed to the management of IBM. You would hope the management of IBM would understand their business very well and not buy back in non-opportune moments. There's a lot to be said about that business, but it's what's done is done. And looking at, for example, Dow and LYB, we know that their businesses are highly correlated with global economics, right? So if the economy grows globally, so will their business, because their business is actually vital for the global economy. And through that, we can kind of project that the growth rate of the industry as a whole will be in line with the global economy. Now, if we take a look, for example, at Dow, let's look at Dow, and then we'll skip over to the financial model. We can see they've only been public for very little amount, right, of time. What do you think about this? This is actually misleading.
I'm not even too sure like what to think about this.
All right. Well, they've been public for a really long time. It's just right now they were Dow DuPont before. And then they actually spun off DuPont to another company, which I actually really love in a different way. It's International Flavors and Fragrances. So IFF. So they became one company. And then Dow is spun off as its own company for focusing on chemicals. Now, I actually prefer, of the company I mentioned, I should do a video on International Flavors and Fragrances and its competitor, which I love even more. Leave a comment down below. And also, we forgot to ask. We should have asked this at the beginning, but
we should have. Yes.
If you guys prefer, we'll ask it again in another video. But if you guys prefer long form content, leave that down below. If you prefer shorter content, also leave that down below. We're going to try to see what everyone wants, and then we're going to maybe do a mix, because we want to do long form content because we think that allows us to get down in the weeds. But we also understand that some people want short form content because it gets to the point quickly, and they don't really want to be bothered with some of the other stuff, because they don't, the people have lives and stuff. So we want to cater to kind of everyone, be more all encompassing. So anyways, for Dow Chemical, they've been around for a long time. It's misleading to think that they've only been around since 2019, but they just spun off. Okay. So what we want to make sure is to keep that in mind, that they're not just some random new company that just IPO'd. They're not. They're really old company. All right. With that being said, let's hop onto the model, and
let's do it
right here. So
our one and only trusty model, Fabio.
So right here, I'm applying an extremely high discount rate and applying no buybacks. Okay. We can see that they've actually been buying back shares over time, which I've hinted at with LYB. If you think this is a cheap company, then you want management to be buying it back. And mind you, I am discounting it very heavily. Right. I don't think.
Why is that? Why such a high discount rate in this instance here?
It's just a starting point, but I want to distinguish between what I or you were to be discounting it at and what management would be discounting at. Because remember, we discount it higher because we are not working in the business itself. We are not the operators. We are
subject matter experts either. Yeah.
We are investors. That's all we are.
Yeah.
So if we were the CEO, the CFO, the management team, we could apply lower discount rates because we know more accurately, for example, exactly what are the potential risks with the business, right? And then we can be a little bit more honest, or not honest. We can be a little bit more informed and more precise with the discount rate. But just being pretty conservative here, we can see that if they achieve a growth rate of 10%, which they've been achieving over the past years, by the way, look at that. Then, right, and only then, this company is actually a buy. But under the other assumptions, it's not true. And mind you, I have the custom weighting here. So we ignore this because I don't want people to think that this is the definitive portfolio allocation that I would.
It's just like a base point by which, yeah.
And it's doing it based on the risks assumed by the model and the assumptions I have placed, and also my request that I want a 20% rate of return. And it's saying don't buy, because it's look at what it's doing. It's implying, or it's counting, a -% growth rate, a 4% growth rate, a 6% growth rate, and an 8% growth rate. And it's saying that they're all possible, and they're all possible by this amount. Okay. But anyway, analysts, for example, they say this thing is a buy with a 26.2% possible rate of return. They may be right. Okay. And if they're right, that's I think their 1-year price target. That would be a good return, a very good return, market beating return, in fact. However,
so yeah, no, go. Sorry.
No, ask the question.
I was kind of wondering, in this instance here, if this was reflective of what we were talking about at the beginning of the video, where this kind of presents that sort of opportune buy for at least you here, because to me, at least what I'm seeing, it doesn't. But then again, we are discounting it at 20% as well.
We're discounting at 20%, and we're assuming their buybacks stop, which they're most likely not going to stop. You see, all of a sudden, boom.
Yeah, it does. It changes the story.
Yeah, it does. So the buybacks change the story, and I'm not going to assume I do anything with the dividend. I'm going to take the dividend and I'm going to pocket it, and I'm going to spend it somewhere else. I'm going to go buy whatever I want with it. But if you take into account the dividends themselves, right, you could be accumulating more and more shares and have that compounding effect. And that compounding effect can be actually quite powerful, because you're buying more shares with the cash they give you. And then so you're accumulating your ownership percentage of the next iterations of cash flows will be greater and greater and greater. You will own more of it. All right. So you have to count that in the return. Okay. So, but I'm just assuming, about 2% of the buyback or dividend effect. But yeah, that's going into the ownership percentage of the business.
And now kind of moving on to the key stats of LYB before we move on to the key ratios or even DOW. I see an exceptionally, or at least what looks like to me, a high book value. Is this a company where book value really matters to you? At least where my mind goes with this, I would say yes, because it's a very, very asset intensive business. But that would just be my thoughts about this.
Book value matters, but I doubt you'll ever get a company like this at book value. If you do, that is a strong deal. In fact, actually, let's take a look at LYB right here, because I think they got very close to it during the pandemic. They did. Yes, $42. So at $42, you were $5, or sorry, not $5. You were $7 away from the book value. Incredible. All right. So a company like this, if you ever get the chance, and the world's not ending, okay, that's the key. The world is not ending. Then it would be very good deal, like one of the best deals you've probably ever made, if you could get it at the book value. All right. And when I say best deal you've ever made, it indicates also, or it counts the risk involved, the volatility involved. You're getting it at almost replacement value, and then discounting and saying that the whole business is almost worthless. And it's not. This thing is not going to be dying anytime soon. This is one of the largest companies in the entire world in their sector, and has incredible staying power. So that being said, can you only imagine what you'd be able to imply? You'd be able to imply a decay of I don't know how much for decades, right? So look, even a 1% decay, you're significantly above that. So let's actually
you could even assume dilution in a sense as well, and then you could discount it like no tomorrow too.
Yeah, wow. It was implying a 10% decay every year for 10 years at that price.
Wow.
With
a 20% required rate of return. 20%.
And you would still, exactly.
Wow.
Precisely.
Holy cow. So, okay. So this kind of adds more nuance into my own thinking approaching these. So not to exactly apply the box here because companies vary, industries vary, sectors vary. Especially a business like this, that I kind of like to think of this company, LYB, as a company by which, as I said, they build the DNA of multiple other businesses.
Yes.
So in this
Correct.
instance, book value would matter to me. Now, just to kind of sidetrack before we get back to the chemical companies at hand here, in another business, let's say a grocery store, for instance, because I love grocery stores. I do. I just do. Grocery stores, that would book value matter in that instance as well?
For grocery stores?
Yes.
No, not really, because grocery stores, I mean, again, if you could get it at book value, that's a different story, but
Yeah.
or below book value. I think one of my investments is Ingalls Markets, IMKTA. And this one you got to go to the stores if you haven't experienced their stores. I call them like a nicer version of Publix. I like their stores. I don't know why. Maybe I'm
I
crazy.
definitely have to go sometime then. But
Yeah, but
yeah, so no, go. Sorry.
no, it's I mean, in Publix is considered to be
I don't
nice,
mean to
but
keep interrupting you, So
no, but to answer your question, it was trading at below book value.
yeah.
It was. And I was like, whoa. But there's a little caveat to that one. And there's a reason why. So you can understand, like we always say, there's nuance in everything, and there's nuance within company to company. So I wouldn't expect a typical grocery store to trade close to book value. But with something like Ingalls or even ACI, because I know ACI's owns some of their stores, they can sometimes trade closer to book value than other stores that rent or lease out their entire store space. So I wouldn't expect those to trade close to book value. Those, because they don't own the real estate, I wouldn't expect that. But yeah, that's the
Yeah.
answer.
And so what is the criteria then? It begs the question, what is the criteria for book value? What are some indicators that you like to see whereby then you're like book value matters in this instance?
Oh, it depends on what assets that we're accounting for in that book value. For example, I don't like to count inventory. I really don't. I like to assume inventory is worthless in most parts. For the most part, depending on the business, I say that again. And yeah, but like, for example, if it's gadgets or gizmos, and they're valuable this year, but when the new and next better one comes out next year, they're not going to be as valuable. So I'll discount those to zero just to be conservative, right? But for example, if it's something like real estate on the books, or bonds, or other forms of securities, assets like that, I would like to take that into account. Okay. And
Yeah.
then I like to subtract out the liabilities that go against those, right?
Yeah.
And debts that are real and tangible and you have to pay back, all those, go into the book value. And again, that's kind of me. I don't like to always take the management's book value for granted. I don't just say, oh yeah, that's the book value. I like to go in myself and make a more conservative one. And then if it's trading anywhere close to my conservative book value, or what we can call replacement value, then it's potentially a very risk-off investment. And I like that. But I don't expect these companies to trade close to book value. If they ever do, then we're looking at something pretty interesting. It's the risk is being put off. Now you have to ask, the question is like, okay, so this thing is priced to death. Is the world ending? And the answer is no. It's probably a good investment. So
Okay.
again, and then why is that important? Because in the beginning I said, if with these kinds of investments, I think what really matters is the price you get in.
So price is really what matters. All right. Well, kind of going back to DOW now, let's kind of see DOW in the model. And
so
are you bearing in mind, structuring my mind kind of coming into this? Hopefully the audience is following along with this. I'm already coming into this with the presumption that DOW would be trading relative at a price premium in this instance compared to cash flows. So I'm actually quite interested to see what the story will look like if we were to apply the same growth rates, the same discount rate, the same buybacks, which actually interesting. Oh my.
Yeah. So
Dan corrected.
Yeah. So you can see very clearly, and I'll kind of put them, go back and forth, but we're applying -1, 4, 6, 8, and 10. And I did 1, 2, 3, 4, 5, 10. So, but you can see even at 10%, we're not in good shape. Let's remove the buybacks again to keep them even. And you can see just on this, at a 10%, no buyback, same required rate of return, we're still here. And then Dow, I'm assuming a buyback of 0.17%, which is their average. And this could be probably going up. And at 10%, it's still not a buy. So you can see there's a premium attached to a Dow. Now you have currency risk. I didn't talk about that. So LYB being in the UK, you have currency risk. Not that the pound is a risky currency, but if you're an American, and then, or if you're in the Eurozone and you're investing in a company who's using a different currency than you, you do have to account for currency fluctuation. That can be to your benefit or to your detriment. And then just keep that in mind. So it just depends on where you're living. And also you can see here, you see book value is 22.23. Analysts have this as a buy with a price target of 65.23 plus 18.8% potential rise within 1 year. Okay, still
So now
not as good as LV.
Yeah. And you know that I'm going to ask you about the currency fluctuations and how that can kind of manifest itself maybe in the price. Would you say that this is likely priced in for LYB? Would that be a correct assumption to make here?
No, because I'd say no, because you don't know what's going to cause the price or the currency rates to drop between the pound and the dollar, for example. We'll find out, but if it happens, it will then be reflected into the price. It would either rise or drop. And so, for example, let's say the dollar goes down to the pound and you invested in LYB. That would actually be to your benefit if you're an American. And then if you bought, for example, Dow and you're from the UK, in that case, if the dollar drops to the pound, it's to your detriment. Okay. Because Dow is making money in dollars and will be paying you based on dollars. So you'll notice that your pay goes down for your dividend, for example, because of the currency conversion. They're going to be paying the same amount in dollars and they're going to grow their dividend in dollar terms. But you're going to be receiving pounds because it converts and goes into your broker. So that's why sometimes it's really good to have these international brokers that they can settle it in the home currency. But that's not a conversation for this.
Yeah, that's a separate
conversation.
You're just kind of providing color to the canvas here.
But with LYB, if you're an American, you can diversify away from the dollar. And by buying LYB, you're going to be receiving dividends in pounds. And if the dollar collapses, let's say that, right? The dollar not collapses, but comes down a little bit, then you're actually going to exacerbate your gains because it's derived in pounds and a lot of their income is in pounds. Now, you'd have to look at each detail of each business and where they derive their incomes from. So like Dow in isolation from the American side, if you're an American investing in Dow itself may be globally diversified, which helps them mitigate dollar risk, or sometimes maybe it's to their detriment because the dollar is rising, right? And then so it would have been better if they were only getting in dollars, right? But that's not necessarily the reality. So you want to pay attention to that, but in isolation of the markets, that's what I'm talking about. But it's still, if the dollar goes down and you're British investing in Dow, you will experience a little bit of a lower rate of return because Dow stock is derived in dollars, and so is their dividend.
Interesting. Okay, cool. So is there something here that is just really surprising you? Like, is there something out of what you're looking at here with Dow that just like really pops out to you immediately that might be a good or a really, really bad thing to kind of keep an eye on in regards to this?
I mean, good return on invested capital and return on equity. I didn't even see for LYB. Return on equity and return on invested capital, pretty similar. Yeah, very, very similar. LYB is actually better. And this is what I was talking about, that despite having better metrics, LYB is trading cheaper just simply because of the situation we're in now. And look at that. The dividend payout ratio is lower on LYB. The dividend yield is I don't think that's correct, but the dividend payout ratio, that's I think that's spot on. And it's lower than Dow at the very least. And that shows that it's more conservative, and yet it's trading cheaper. And I think they have a comparable dividend yield if you really look at that.
Okay, yeah,
So
because I was about to ask again if because you had indicated earlier that with the United Kingdom, there's a price premium in the United States because people want to invest their money in the US. But is there also sort of kind of a wisdom of the crowd happening here? Is there like a macro potentially happening in the United Kingdom that might be deterring investors at the moment from investing in these markets?
yeah, you got like Brexit stuff, but I don't think that
Okay.
matters. It doesn't really matter.
True. All right. Well, with that being said, do you have any other closing thoughts before I wrap up the video here today?
No, simply that going into this, I'm more interested in LYB than before, and I actually might consider adding a position to it, but that would be requiring a little bit more research into it. But definitely
Yeah.
something I'm interested in terms of the materials sector. Yeah.
Yeah, I certainly think the stock is interesting too. I've enjoyed learning about it. For me, it's a long way away before it potentially makes any entrance into my portfolio. So for right now, I'm still keeping my eye pretty closely on Dropbox, but this is definitely an interesting company. But with that being said, we are your hosts, Austin and Fabio. If you've liked what you've seen here today, please be sure to share the video. It really, really helps out the channel. Please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. We are your hosts, Austin and Fabio, and we look forward to seeing you guys next time. Take care.